Are your investments liquid or are they locked away? Keep listening as we dive into the importance of liquidity. Welcome to the Money Meets Medicine podcast, where we talk all about the personal finance topics you wish you had learned in medical school. I'm your host, Dr. Jimmy Turner, and here is your co-host who has seen not one, but two people speared by a javelin while in high school, Justin Harvey.
Thank you, Jimmy. Pleasure to be here. Yes, my athletic career in high school does include that rare distinction, and it's quite jarring when you see it happen in person. None of these accidents were fatal, by the way. It was like somebody got hit in the shin and then somebody else got hit in the foot. So it's kind of, you can look back and laugh. But yeah, I threw javelin in high school, the pinnacle of my athletic career. It's been downhill ever since. And you give a 17-year-old male a pointy stick and tell him to start chucking it around crowds of people, and something like that is bound to happen eventually. So,
yeah, I have never thrown a javelin. I have never thrown a disc. A discus? Is it a disc? A discus?
Yes. Yep.
I have thrown a shot put, and I was obviously horrifically terrible at that, given my 140-pound soaking wet size as a senior in high school. But I pretty much avoid all things track and field. In fact, my wife has been able to run a faster 5K than me since the day that I've met her, and that continues 16 years later. So, yeah, it's just those are not my sports, not my thing.
Yeah. Track was I enjoyed very much in high school. My wife is the real jock of our family. She was good at everything and still kind of is. She played tennis in college and marathons and basketball and soccer and all that stuff. So.
Well, there you go. Hopefully your kids get the athletic genes from your wife.
Yes, indeed.
So, Justin, on this show, I'm actually interested to talk about this idea of liquidity, and we're going to talk about how doctors get talked into maybe some illiquid investments, why that matters, and the whole 9 yards. Something we haven't really chatted about on Money Meets Medicine before. Before we get to that, just want to remind folks, if you're looking to start your financial journey and create the foundation to your personal finance life, don't forget to snag your free copy of the Physician Philosopher's Guide to Personal Finance. You can also get quotes for own occupation disability insurance from a source that you can trust, all at moneymeetsmedicine.com. And we are happy to help you with both of those at Money Meets Medicine. So, Justin, I'm curious if let's just say I'm one of your clients, right? You're my financial advisor. And I'm like, hey, Justin, I've heard this word liquidity. I think I know what it means. I'm a little embarrassed to ask, how would you define that for someone who hasn't ever really thought about this concept before?
Yeah, liquidity, it means a couple different things. In the context we're going to discuss today, I would say it's the ability to turn something into cash. Is something liquid? If I can turn it into cash within a day or two or three, then it's liquid. Cash is liquidity, literally. That's what we're talking about. So the liquidity as an adjective describing how liquid is XYZ investment, it's how easy is it to turn into liquidity, cash. And so when we're talking about liquidity in terms of different asset classes, there's a wide range of liquidity, and it's a spectrum. And on the one hand, we've got a stock or an ETF that you sell it and it immediately turns into cash on the spot. And there's a robust secondary market, also known as the stock exchange, where you sell a thing and somebody else buys it and you get the money in your pocket right then. The other extreme would be, there's different permutations, but a private equity strategy or a real estate strategy that can be 5 or 10 years or more. You can't turn it into cash for a decade. And so, sure. And then there's everything in between. So understanding where your investments fall on that spectrum is pretty important.
Yeah, and as I'm hearing you explain this, right, I'm thinking in the back of my mind, what sort of things would somebody need liquidity for? So, for example, when you're talking about stocks, ETFs, I can understand that. I think about my investments inside my 403B, right, which I don't plan on touching for 30 years. I kind of start thinking about scenarios where you might need liquidity. Obviously, we did a recent show on emergency funds on, I think, February 21st. Obviously, a huge liquidity need there, right? That's when emergencies come up. You're going to need some cash quickly. And maybe, it has something to do with, short-term savings goals. Maybe you're saving for a car, you're saving for a house, and you don't want it locked away. If you don't know exactly what the timing is going to be, let's say it's variable. Hey, we don't know exactly when we're going to buy a house. We're still, waiting on the market, waiting for the right house. When are some other opportunities when, liquidity really matters for people. Like we're going to talk about trading liquidity for other options. Why does liquidity matter so much?
I think the reason that I proposed this topic and the reason I feel strongly about this is it's not liquidity inherently that is like super, super important. Because if you want to think broadly about all your investments and your net worth, if you look at what we call your balance sheet, all your assets and your debts, really today we're talking about assets. Everything that's listed on your assets, it's your 401k, any investment accounts, if you have a primary residence, any rental real estate, if you own a business or a medical practice or a surgery center or anything else that you own. Each of those has sort of a different liquidity attached to it. Like how long does it take to turn every one of those into cash? And you want to think about your balance sheet in terms of this is another way in which diversification expresses itself. So
Sure,
it's fine to have everything super liquid, but what's risky is to be concentrated in illiquid assets. And, there are people that have gotten rich doing that, but there's a lot of people that have gone broke doing that as well. And the problem with an illiquid asset, if you own, for example, a portfolio of rental properties in a single market, and it's a market in a high tax jurisdiction in December of 2019, when my son Calvin was born, to inaugurate the COVID pandemic. That was a time in which a lot of people had some feelings about different jurisdictions and different geographies, and all of a sudden everyone's remote and people are moving out of places. And if you own 20 houses in a town where no one wants to live, all of a sudden, the real estate markets kind of lock up, and then everyone's moving to Texas, everyone's moving to Florida, and they're moving out of some other areas. All of a sudden, you can't sell any of your houses. You're dropping the price. And because of the illiquid nature, you have to sort of ride that roller coaster all the way to the bottom. And it's a fire sale, essentially. So the problem with lack of liquidity is, if somebody who, instead of holding 20 rental properties, had a more diversified situation from a liquidity standpoint, if they had some stocks and some bonds, some ETFs, some other more liquid assets, treasury bills, et cetera, then if they needed capital, they wouldn't need to sell the assets at a significant loss. So go ahead.
Yeah, I was going to say, it almost reminds me, when we talk about the real estate scenario, it's almost like not just the opposite of liquidity because you can't tap into it quickly, but it's almost like the double opposite of liquidity, because not only can you not tap into it quickly, but in addition to that, if you don't have tenants, now you have a negative cash flow that's sapping any other liquidity you have. So it's almost like a double hit in a lot of ways if you have that situation.
Yeah, real estate is unique in that way. There's other investments that aren't tangible property the way real estate is. And I'll just tell a quick personal anecdote. And one of the reasons that I have like some PTSD around this. And by the way, every advisor, I'm a financial advisor. My opinions have been formed by my experience. And this is going to be true for anybody else. My first few years in the industry, Jimmy, you and I talked about Jim Simons, who's the maven, like genius math guy who created the Renaissance funds. And we actually had early on, we had some clients who invested in some of the Renaissance funds, and the sophistication that they were using to build these, like the coolest financial instruments out there, it's unparalleled in mankind. And that is an alternative investment. And that is an quasi illiquid investment. It really is the genuine article. It is the reason that all these other people who's selling all these other things say, hey, look, like they sort of point to something like that to say, special strategy, we need to hold the capital to be able to invest it at our discretion, to be able to enact, the strategy required to get these outsized returns. And so there is a real thing out there that is less liquid for a good reason, but there's a lot of other pretenders. And I would say the next job I had after that one, where we were involved with Renaissance funds a little bit, there was this illiquid investment. It was a mutual fund. It was quarterly liquid with what's called a gate, GATE gate. And that means that the fund has the ability to allow only a certain percentage of their total assets to be sold in a given quarter.
Okay.
So if there's 100 million of assets and like the fund tanks and everyone is like, oh my gosh, get me out of this. This isn't delivering. If it goes from 100 to 70, the gate may kick in and say only 10% of the fund assets are going to be distributed at any given time. So if there's 70 million of assets and investors totaling 50 million try to sell everything, you're only going to get like a very tiny pro rata redemption. If you try to sell $1 million, you might only get 150 grand back. And then the next quarter comes and you try to sell your 900 grand because it's going down and they only give you 100 grand. And so it's this like death by 1,000 paper cuts because you can't turn it into cash because of this gate function. And so this is particularly painful when you're watching this train come off the tracks with this strategy that's not doing what they told you it was going to do. And all of a sudden it's you're locked into it. So
yeah,
that particularly is the strategy that makes me think twice about something that I can't get my money out when I want to, especially in a mutual fund format. This is like what's called a closed-end mutual fund, which is a little different than a normal, like I bought it today and I could sell it tomorrow. And so you just gotta, it's really important once you get out of anything daily liquid. And daily liquid, I would say like treasury bill, mutual fund, ETF, stock. That's all daily liquid. We sell it today, we have cash tomorrow, more or less. If it's not daily liquid, you want to understand what are the terms of liquidity, what are the trade-offs, and think about the worst case scenario. If this thing starts tanking, and like, what is the stress test going to yield for you if you do try to sell everything and then sell everything and then sell everything every quarter for like 4 years, which is literally what happened with me. Imagine having to place a sell all order every quarter for 16 quarters. That's a pretty painful experience.
Yeah, no, I agree. It kind of reminds me, I'm terrible at remembering like actually people's names, movie names, any of that stuff. But what is it? It's a Wonderful Life or something like that. The Christmas movie, like when people make like the run on the bank, and it sounds like a gate is like the mutual fund's way of like saying, hey,
precisely.
if we have a run on the fund, then this is the way for us to protect the money or the investment so that everybody can't pull everything out at a loss, and then people, some people don't get their money.
That's right. Yeah. And it prevents a fire sale from happening. Like if you're selling a certain type of asset and you got to dump all of it at the same time, you have to just take pennies on the dollar because of you're flooding the market with that certain asset. And so providing the gate allows a fund to sell it little by little and hopefully preserve the value of that asset a little bit more. But it's problematic for the investor.
Yeah, it makes a ton of sense. And this conversation, is really interesting because actually, I don't know that I've thought of another situation in personal finance exactly like this, other than one thing, which is, when people have the conversation about like investing versus paying off debt, and we all might break it down into like different interest rate break points, right? For me, it's like typically, less than 4 to 5% is kind of low, 5 to 10 is kind of medium, anything above 8 to 10 is high. And honestly, that's going to depend on, a variety of things like inflation and interest rates and yada, yada, yada. But one thing I find is interesting that always comes up in that conversation is like the guaranteed quote unquote return of paying off debt, right? Like, if your debt's humming along at 6%, you pay that off, like you're going to make quote unquote 6% guaranteed. And so, that for me is why like medium interest debt is prioritized over some other things, because that is guaranteed, and comparing that to the potential variable interest you might get, right? So you can't say like, well, I'm expecting 6% in the market and I've got a 6%, auto loan, and therefore they're the same. It's really kind of apples and oranges. And so when you think about liquidity, it's a little bit, similar in that, yes, it's supposed to spit off some income, but that income and the price that you're paying for it is not apples to apples with, let's say, another investment where you could make money, but then still be able to tap into it if you needed to. Like it's almost like there's like an added, like you need to add a percentage point to the ability to tap into something in order to like make those, and not a percentage point, but some amount of value in order to start comparing those two things, because you are paying a cost for not being able to tap into those funds, right?
Yeah. So, and then if you're thinking about, I think you're describing like constructing your balance sheet in a way that allows the maximum access to capital over time. Like if you're building up a taxable investment account versus paying off debt, if you're paying off a car loan, that's great. But then if you need money all of a sudden, you can't you could do like a title loan on your car, but that's not a good deal. And nobody listening to this podcast should probably do that. Whereas if you're building up an investment portfolio, you can use those investments. And hopefully the expected return of those investments over time are going to be higher than that, number. So in terms of the adding the benefit to the asset because it can be accessed, I would sort of handicap it that way in that trade-off. Is that kind of what you're saying?
Yeah, no, it is. There has to be some adjustment, whatever you want to call it, to make it a conversation of like, when is it worth it, right? Like when is it worth the things that I'm losing? And
Right.
I think this is a really important topic. It might seem a little ethereal at this point, but I agree with you. We were talking about this before the show in terms of, doctors kind of being pitched illiquid investments. And, I've gone on my soapbox, my rants in prior shows about this, but, probably the most common one that I see is real estate, right? And I'm not an anti-real estate person, so I don't want to, cast it in that light because, sometimes it may sound like I'm an anti-real estate person, but I'm not. I actually have seen lots of people have a lot of success with real estate, and real estate investors will commonly point out like, well, the wealthiest people in the world, they all have real estate, yada yada yada. Like, we can lay out all the arguments, but one thing factually, black and white, that you're giving up when you invest in a lot of real estate opportunities is that liquidity. And so if you're going to do that, don't do it because of YOLO. Like, you're worried about missing out on, or FOMO, I should say, not YOLO. That's a different thing, by the way. But FOMO,
but related.
Like, you're worried. Yeah, they can be. So, but you're missing out on what other people are doing. You're like, well, but I've seen so-and-so be successful. They've got these 10 properties. It's spitting off this much cash. They could cut back and go part-time in medicine or retire early. And so I want to do that without thinking through the cost of what it means to wait for quarterly distributions, or to maybe not get one, or to have that deal fold completely, right?
Yes.
There is a cost associated with those opportunities.
Yeah, I find that for this discussion that we're having today, FOMO is a huge sort of driver and the thing that I want to address in the room, because this is where, the doctors hear through the grapevine about what the other quote unquote smart doctors are doing, or the ones who have the inside information. And it often is this illiquid bucket. Also, often this is like an alternative investment is kind of another word used to describe this. An alternative means it's not a stock and it's not a bond. It's something else. Could be real estate, could be private equity, venture capital, closely held businesses of some sort, and other things too. There's a lot of different, alternatives means a lot of things. Some of them are daily liquid and some of them are never liquid. And then there's everything in between. But if you're thinking about alternative investments in general, this is where you get into that territory of some of the stuff is going to be illiquid. It's going to have a lockup. It's going to have the gate. It's going to have provisions that may be onerous in terms of, can I turn this into cash? And so, A, do you need it? Maybe not. You got to talk to your advisor about that. But B, if you're going to sort of dip your toe in this pool, you need to understand in terms of your balance sheet, like, what percentage of our net worth are we willing to tie up in something that we may not be able to turn into cash for 5 years, or whatever the terms are? Because you do want to think about the durability, the robustness of your financial situation. If you do get hurt, if you go on disability, if, God forbid, you have some sort of like crisis in your family that has serious financial impact, death of a spouse or something, a kid gets sick, and these things happen. I've seen these things happen with clients of mine. I like to be able to be flexible, to be agile, to adapt, to adjust. And if you've got, 50% of your net worth tied up in this thing that you can't ever turn into cash, then it limits your ability to adapt and adjust.
Yeah, I think FOMO is a huge part of this. And the reason behind the FOMO that I've seen, at least, is that people want to get to their goals faster. In other words, they're trying to hit grand slams or home runs instead of just being like, you know what, I'm just going to hit singles and doubles. Like, I'm okay with it taking, 12, 15, 20 years with my very boring, low-cost, diversified index fund strategy. And then someone comes along, they're like, well, what if you could do that in 7 years? And then naturally they're like, let me tell you how, right? And it's, cryptocurrency, or it's real estate, or it's, name the investment that's, stylish right now.
Yeah.
And all of that is driven by like this FOMO, which for me, like, coming from my coaching background, like, I think it's so important to really dig into, okay, what are you running away from? Like what in your job or your life makes you want to get to that financial goal 10 years faster? Like what is the house is on fire scenario that's causing you to look for these grand slams or home runs? And you really need to investigate that and figure out, okay, am I trying to, put this salve or this treatment on something I haven't diagnosed, which is typically in the coaching world what I see. People are like, oh, I'm going to change jobs, I'm going to move, I'm going to do all of these things that are going to cost money and put stress on my family. and they never really spent the time figuring out like what was wrong that led to this FOMO that then led to these alternative investments that I may not even need to take part in. I think getting to the root of that is fundamentally important.
Yeah. And, I totally agree. And there does come a time in somebody's journey I could say the same thing about like a whole life policy. Like, I don't think there's many doctors out there in their 30s that should own one. And Jimmy, I know you're going to put the disclaimer on the end here, so we don't need to get into product specific disclaimers, but I see them sold a lot, and I see very few doctors who should actually own one. But by the time you get to like, I'm making really, really good money. I'm saving 20, 25, 30+%, and I'm stuffing money. Like, I filled up my 401k. I'm doing the 1099 thing with a SEP IRA or a solo 401k, doing the backdoor Roths. I'm doing the taxable account for 10 or 20 grand a month. Like, should that person do a whole life? I mean, sure, why not? It kind of doesn't matter at that point. I feel the same way about alts, and you could call life insurance an alternative asset class. And there are some liquidity constraints in some of those life insurance policies. Like, it's the icing on the cake. It does, in some cases, provide a nice uncorrelated return stream. And they can be a good solution in certain contexts, but often it's the illiquid types of investments are like once you're well on your way. You've paid off a lot of debt and you're cruising.
I've thought a lot about this, and the reason why recently, and the reason why is because of my experience at Attend, right, running a venture capital backed startup, and getting introduced to that space and the people in it who are completely amazing people trying to solve big problems. They're very entrepreneurially minded. It is very contagious. It is a wonderful group of people to be around, and immediately just by being around those people, it makes you believe in them, and so. Absolutely. At some point when Kristen and I get to the point where like we have a lot of, liquidity and additional funds that we have at our disposal, and we've already won the game, and we're looking for maybe some alternative investments that we want to try out. Like, I could absolutely see myself doing 5 or 10% of our overall asset allocation and putting that into VC opportunities. That is going to be highly illiquid. Just like private equity would be. And so these are two other examples, angel investing, outside of real estate. So I'm not ragging on real estate this entire show, of specific opportunities that doctors get approached about because you're a high net worth, an investor that's allowed to invest in these opportunities based on your income. And so, given that, we do get a lot of illiquid opportunities, and me personally, like, at some point there's a good chance that I'm going to put 5 or 10% of our asset allocation into something like that because I think it's great and I believe in it, and I want to support entrepreneurs that are trying to solve big problems, recognizing that it is a home run, right? And there is a really good chance that you're going to strike out. So you don't want this to be a part of your portfolio that like you're depending on for just absolute success. Like, like this is the guaranteed sure way to get there. But if you want to take a little bit and be risky, I don't want to say call it gambling, but it is speculative. Then that's fine. But don't do it with 50% or 100% of your portfolio, right?
Yes, absolutely. I think titrating illiquidity to suit your time horizon and risk tolerance is the order of the day.
Yeah, absolutely. Well, hopefully the show, interesting idea for you. Maybe you haven't thought about this before. Maybe you've been approached about a real estate opportunity or VC or private equity or whatever it might be. Before you do that, make sure you think about your liquidity needs, whether it is, that emergency fund or the opportunity to have a, charitable giving opportunity you didn't see coming up or whatever it might be that requires that flexibility, Justin, that you're talking about. And as always, as you're listening to the show, hopefully it was helpful for you while you're driving to work or doing laundry or whatever you're doing. Make sure to leave a review on iTunes. For Money Meets Medicine helps people find the show and share the word with the community. If you're looking to snag a free copy of the Physician Philosopher's Guide to Personal Finance, or you're looking for an own occupation disability insurance quote, make sure to visit moneymeetsmedicine.com where you can do both of those things. Justin, I guess I'll see you next week.
Sounds great. Thanks, Jimmy.